Okay, so this is Tax Tips for Medical Professionals, and my name is Jessica Chisholm. I'm a CPA here at Huddleston Tax CPAs, and we're located just outside of Seattle, Washington. Before we get started on the actual presentation, just want to make sure that everyone is registered at smallbusinesswebcast.com. I know some people come to us from other websites, so I just want to make sure you're registered here. Just wanted to also point out some of our future webcasts that we're having. On November 8th, I'll be doing a QuickBooks overview. On November 16th, Jennifer Zhao, a CPA in our office, does 7 tax tips for the self-employed. November 23rd, we have tax tips for lawyers with Lance Holbert. On November 29th, I'll be doing starting a new business, a to-do list. So if you're getting ready to start a new business, that's a good one to attend. We also have a search engine optimization webcast, and then John Huddleston does LLCs and S-Corps Explained, using them to reduce taxes. And also we have a year-end tax savings to-do list that would be great for year-end tax planning. So again, if you're not already registered at smallbusinesswebcast.com, I recommend that you get over there and get registered so you can be made aware of all our future webcasts. Also, I just wanted to show you our website, huddlestontaxcpas.com. We are available for pretty much anything accounting-wise having to do with small businesses. Do tax prep and planning, small business coaching, QuickBooks training, bookkeeping, payroll, pretty much anything you need. So if you're looking for a new CPA, check out our website. You don't even have to be from the Seattle area. We do work with clients all over the country and all over the world for that matter. Okay, so let's go ahead and get started with the presentation. First thing, I want to talk about everything I'm going to go over today. I'm going to talk about entity selection for your business, the auto deduction, the home office deduction and who qualifies, medical equipment, whether it's better for tax purposes to buy or to lease, hiring family members, the benefits of that, talk about deferring payroll taxes on owners and how that can reduce or lower your taxes in a certain year, and then other miscellaneous deductions just to keep in mind. So the first thing is business entity selection. When it comes to choosing the best entity for your business, you do have several different choices. It just depends on what sounds best for you and your situation. The different choices are the sole proprietorship, LLC, partnership, C corporation, and S corporation. So sole proprietorship is the easiest to set up. All it pretty much requires is a business license with the state. But you do pay self-employment tax on 15.3% of your profits. With a sole proprietorship, there's no need for a separate tax return. It's just your business income and expenses are reported on the Schedule C of your personal Form 1040. So if you just want to get going, minimal setup time, don't want to have a separate tax return, that sole proprietor could be the way to go for you. Then there's the LLC. You can either be a single-member LLC or a multi-member LLC. Single-member LLC is taxed as a sole proprietor. So it's the same. It's reported on the Schedule C and your personal Form 1040, and you pay that self-employment tax on all the profits. Or you can elect to be taxed as an S corporation, which I'll talk about in a minute. You could see why that could possibly be a benefit. A multi-member LLC is taxed like a partnership. So you fill out a partnership tax return just like if you were a technical partnership. So with a partnership, it's 2 or more owners sharing in profits and losses. You do file a separate tax return, Form 1065. That a partnership return is a flow-through return, so you do not pay any tax at the partnership level. All your income from the partnership flows through onto your personal Form 1040 and is reported there. If you're an active member in an LLC or you're a general partner in a partnership, you will pay self-employment tax of that 15.3% on all those profits, just like the sole proprietorship in a single-member LLC. Next, there's the C corporation. The C corporation, you pay tax at the corporate level and also on dividends that you receive from the corporation. So when people talk about double taxation with corporations, they're talking about C corporations. So the ways you can get money out of a corporation are to take dividends or to take a salary as an owner. Both the dividends are taxable to the corporation, are taxable at the corporate level and on your personal return. And there's no flow-through income onto your personal return like on the other entities. With an S corporation, you are able to avoid that double taxation, and you can also possibly save on self-employment tax. So again, you can either be an LLC and elect to be taxed as an S corporation, or you can just form an S corporation from the beginning. What happens with an S corporation is it's a flow-through entity, just like the partnership. So there's no tax at the corporate level. Flows through under your personal Form 1040. And also, you are able to save on the self-employment tax by taking draws. So when you have an S corporation, you have to pay yourself as an owner a reasonable salary. So once you decide what your reasonable salary is, the difference between that reasonable salary and the profit for the year can be taken as draws. And those draws will not be subject to the self-employment tax. They will be still subject to regular tax, but not to self-employment tax. So a quick and easy example of that is if your business has a net income of $100,000 for the year, and you have decided as an owner that $50,000 is a reasonable salary, then the difference between that $100,000 of profit and the $50,000 of reasonable salary you pay yourself, that can be taken as a draw and will not be subject to the Social Security or social self-employment tax, which is essentially Social Security and Medicare. So that's just a really quick and easy overview of the different entities you can choose for your business. If any of those sound interesting to you, or if you're thinking of switching entities, I definitely would suggest you check out John Huddleston's Webcast, S Corp or LLCs and S Corps Explained, using them to reduce taxes. Again, you can sign up for that at smallbusinesswebcast.com. He goes into a lot more detail about the different entities and how it can save you money and what might be best for you. So next I want to talk about the auto deduction. There are two different ways to take the auto deduction on your tax return. First, there's the standard mileage deduction, and then there's the actual expense method. So with the standard mileage deduction, you basically get a deduction of 51 cents per mile in 2011 for every business mile that you drove. So business miles include trips to buy office supplies, trips to meet with clients, going to the post office, going to the bank, pretty much anything, anywhere you're driving for business or errands for business. But you do need to note that business miles do not include trips from your home to your office. One way around this is to make your home office your principal place of business, which I know can be difficult in the medical profession. It's hard to see patients at your home, but some people are able to do it. When your home office is your principal place of business, then every time you leave your house for business, it's considered business miles. So when you are taking a deduction for auto miles, you do need to keep record somehow of those auto miles. You can keep a logbook in your glove box, and if you go somewhere for business, you can write it in a logbook. You also need to write down your beginning mileage at the end of the year and your ending mileage at the end of the year, so you can figure your total miles for the year. So that's important also. Another way to keep track of it, if you're going to meetings with clients, things like that, you can print out the MapQuest type report that shows the total miles and keep track of that way. With the actual expense method, again, you need to keep track of your miles even if you're not using the standard mileage deduction. You still need to know the total business miles driven and the total miles for the year, because you are only able to deduct the business portion of the actual expenses to operate your vehicle. So with the 100% work use vehicle, you only use it for work purposes, then 100% of it's deductible. So you just need to know the beginning mileage and the ending mileage at the end of the year, so you can figure out the total number of miles driven. However, if it's less than 100% business use, you do need to track those business miles again, just like if you were taking the standard mileage deduction. So the expenses that you can include in the actual expense method would be gas, repairs, oil change, loan interest, new tires, auto license, and then also you're able to take depreciation on the vehicle. So then again, like I was saying, you do need to keep track of the business miles in order to determine the business use. And something to keep in mind is that you cannot switch back to the standard mileage method once the actual expense method is used. So that's per vehicle. So for the life of the vehicle, if you in the first year decide to use the actual expense method, you must continue using the actual expense method for the life of that vehicle. So when would the actual expense method be better than the standard mileage deduction? If you buy a brand new car and it's a high percentage of business use, if not all business use, then you're probably going to get a higher deduction with the actual expense method because you are able to take depreciation on that vehicle. So the depreciation could be a large expense depending on the cost of the vehicle. So it's definitely something to talk to your accountant about if you're not sure which would be more beneficial to you, because they can run it both ways and figure out which saves you more money in tax. So next I want to talk about equipment, buying versus leasing. So if you're thinking about buying some medical equipment and you're not sure what's going to be best for you to buy it outright or just to lease it, I'm going to give you the tax perspective here. I mean, there's a lot of things that go into the decision about buying versus leasing, but for the tax side of that argument, lease expense is deductible as it's incurred. So each month you pay, $500 a month for the lease. $500 is deductible per month from your tax return. When you purchase equipment, you need to depreciate it over its useful life. So maybe you buy a $10,000 piece of equipment. You cannot take a $10,000 deduction in that first year. However, if it has a useful life for tax purposes of 5 years, then you would get to deduct the $2,000 a year. An exception for this is Section 179. Section 179 does allow you to expense the full cost of most equipment in the year it's purchased. So if you elect to take Section 179, then it's possible that you could write off that equipment all in the first year. There are some exceptions to this, so if you're thinking of taking 179, I'd definitely suggest talking to a tax professional. Some other things to note is that office equipment and furniture also count for Section 179. So maybe you buy a new couch for your waiting room, costs $500. You could take Section 179 on that and expense the entire $500 in the year that it was purchased. Also, equipment does not have to be paid for in full in order to take 179. You are able to finance it and still take the expense all in the first year. And when you're financing the equipment, it is also important to remember that the interest on that is an additional expense for tax purposes. So in my opinion, when it comes to buying versus leasing equipment, from the tax side of it, it probably makes more sense to go ahead and buy it outright. But again, there are a lot of things to take into account when trying to decide buy versus lease. The lease expense is very straightforward. You just take the expense as it's incurred. But if you want a larger write-off in the first year, you should look into possibly buying it and taking that 179 on it. Okay, so now I want to talk about the home office deduction. Like I was saying earlier, it can be difficult for a medical professional to meet the qualifications to deduct a home office. But I'm going to go over the requirements. In order to deduct a home office on your tax return, you must meet one of the following requirements. It must be your principal place of business, or a place where you meet clients, or the office is a separate structure not attached to your house, or a place where you store inventory. Another possibility is if you do significant amount of administrative work in your home office. So maybe, 3 days a week you're in the office meeting with patients, and then 2 days a week you're at home in your office, or even, in the evenings every night working on all your administrative work at home. Maybe do all your paperwork at home. Then you could still meet the home office deduction requirements. Or maybe you have a room where you store all of your, not just your inventory, but a place where you store all of your records. That's pretty much all the room is. It's just, boxes or file cabinets for your records. Then you could possibly take a home office deduction for that. One way you would calculate the deduction, or the way you would calculate the home office deduction would be using the square footage method. So the example I have here is if you have a 2,500 square foot home and your home office is 500 square feet, then your home office allocation would be 20%. So you would be able to deduct 20% of your mortgage interest, property taxes, insurance, utilities, etc. if you owned your home, or rent and utilities, renter's insurance, etc. if you're renting. Another thing to keep in mind is that the home office must be 100% dedicated to business use. So you cannot have a guest room in your house, which also has a desk for a laptop where you go in there and do work from home, but your in-laws stay there when they come to visit. That will not qualify as a home office. It needs to be 100% business use. So another note down here is if you use your garage to store inventory or even 100% work use vehicle, then you may be able to deduct that space as well. Okay, so Paul asks in the chat, for the home office, couldn't it also be calculated as a percentage of the number of rooms in the house, whichever is beneficial? I know you need to calculate the home office based on the square footage because the size of the rooms, are vastly different. So if you take it just as, maybe it's the smallest room in the house and you have 8 rooms in the house, you can't just take 1/8 of the house if the room is significantly smaller than that. Okay, so the next thing I want to talk about is hiring family members. So you are able to employ your spouse or your children in your medical practice and claim their wages and expense, just like any other employee. There are some things you need to keep in mind when hiring family members. You need to make sure if you hire your spouse and or your children that you keep excellent records of when they work, what their position is, and make sure you keep their pay reasonable for what they do. So you can't hire your 15-year-old son to come in and empty the trash once a week and then pay him $50 an hour to do that. It needs to be reasonable. You need to pay them what you would pay someone else in that same position. Some benefits to hiring family members is that you'll pay by paying your spouse. You may allow them to contribute to a retirement plan in their own name or allow them to get wage credit towards their Social Security that they wouldn't otherwise if they were not working. If your child is under 18 and your business is not incorporated, so if you're a partnership, an LLC, or a sole proprietor, then you do not need to withhold payroll taxes on your child's wages. So you do not need to withhold, or you do not need to pay the employer portion of the Social Security and Medicare on your child's wages if they're under 18. Also, for the kids, you can pay them up to $5,700 a year if that's their only job, and they will not have to pay any income taxes. So hiring your family members can be beneficial to them and to your practice. Again, you're going to be held to a high standard when it comes to records since you are hiring family members. So again, just make sure you document it all really well. Now I want to talk about deferring payroll taxes on owners. So this is if you need to push an expense into a following year, or if you want to wait and pay your federal withholding as an owner until the end of the year. So corporation owners who are also employees, so if you're a C corporation or an S corporation, those are the only entities that can pay owners' wages, then you can defer some of your payroll tax obligations on the owner salary until the following year. So again, if you want to push some expenses, maybe you want to maximize your income for the current year, so you want to push some of your expenses into the following year. What you do is you pay a large percentage of the owner's salary at the end of the year, and then the payroll taxes aren't due until after the first of the next year. So you would pay a large portion of the owner's salary in December, and then the payroll taxes on that December salary aren't going to be due until January, so they are pushed into the next tax year. Another reason that pushing the owner's salary to the end of the year would be beneficial is that federal withholding on your salary is treated as being paid evenly throughout the year. So if you have an S corporation or a C corporation, and as the owner you've been making quarterly tax payments to the IRS with the 1040-ES payments each quarter, you can stop making those payments and instead have the federal withholding taken out of your salary. And you don't have to remit that federal withholding until the end of the year. And it's still treated as if it was paid evenly throughout the year. So you personally are able to hold on to your money longer, and it doesn't have to be sitting with the IRS. So it's another benefit of paying a large chunk of the salary in December. Then I have people ask me, well, how do I meet my cash flow needs throughout the year? You know, I still have a mortgage to pay and all that. When you are an S corporation, you can take draws. So you can take draws throughout the year in place of a salary. And then in December, you can convert those draws into salary. If you're a C corporation, you can take loans to shareholder. So it's like you're giving yourself a loan throughout the year. Then at the end of the year, you pay that loan back and take the money out as a salary. So that's just a little tip for corporate owners on how to hold on to your money a little bit longer instead of giving it all to the IRS. So the last thing I want to talk about are just some miscellaneous deductions to keep in mind. When you pay for your continuing education as a medical professional, that is deductible as a tax or as an expense on your taxes. Also, retirement contributions. You know, consider setting up a retirement plan for yourself and or your employees, because the retirement contributions on the employer side are deductible. Like I talked about earlier, interest on any loans, not just equipment loans, but any business loans that you have, the interest is deductible as an expense. Medical insurance as an owner, it's deductible, and also if you provide it to your employees. And also keep in mind about the meals and entertainment deduction. That is deductible. Mostly, majority of the time it's going to be deductible at 50%. But if you're entertaining clients or you're traveling, make sure to keep a track of those meals and entertainment as they are also an expense. So that was everything I wanted to talk about today. So I'll go ahead and unmute everybody. And if you have any questions, feel free to ask them. If you don't want to ask them out loud, feel free to ask in the chat as well. So does anybody have any questions? Okay. Well, people are thinking about questions. Again, some people came in late, so I want to make sure you're registered at smallbusinesswebcast.com to be made aware of any of our future webcasts. And if you do need any accounting help, feel free to check out our website at huddlestontaxcpas.com. Also, we will be emailing you a PDF of all the slides you saw today, so you can go over them. If you have any other questions after it's over, feel free to give me a call or email me. And we'll also be emailing you a free tax review coupon after the webcast. So what that is you can email us or a copy of your 2008, 2009, or 2010 return. We'll go over it and see if you left any money on the table with the IRS. Our record for finding clients' money is $44,000, so we're always looking to beat that record. So does anybody have any questions? Okay, so if there's no questions, then that's the presentation for today, and I hope you all have a great rest of your day. So thank you.